Today we're going to look at Papa John's, the famous pizza franchise that has not been doing well. This stock used to trade at $140 a share back in 2021, and now it's around $30, low $30. And you can look at the 6-month year-to-date performance. This stock has not been doing well, but it has received a takeover offer from a Qatari-backed private equity fund. And so what went badly wrong, and more importantly, why would somebody be interested in taking this business out? So we're going to break down the financials, and we're going to walk through the Excel model and figure out how can a potential PE fund extract additional value from this investment and whether it is a good investment or not. So you can see here I'm just doing some background research, and this is not the first time that Papa John's has actually received a takeover offer. And the same party has come back again, but this time by themselves, to offer $47 per share. And the stock is currently trading below that price, which probably implies that the market thinks this deal is not going to occur. And looking here, Apollo last year actually partnered with Irth Capital at $60 a share. And I guess luckily for Apollo, they didn't buy into the company because it's definitely done a lot worse than what it was previously. And as usual, what I've done is I've used Claude AI to help me scrape the historical financials and build the basic three-way model, including forecast, DCF valuation, and LBO models, just to make my life easier, and honestly it has helped a lot. And looking through the financials here, there's obviously a lot of things are going on here, where this business owns its own restaurants, but it also is predominantly a franchise business model. And just thinking about the business, we typically think of its competitors as Domino's or Pizza Hut. And it's going to be interesting when we look at the financials to see how different these three businesses are and why Papa John's has not been doing well. Here we can see that most of the revenue comes from commissary revenues, with minor other streams from like advertising, and then obviously the restaurant operating cost is the biggest cost item for the business. You can see here there are a few zeros in the commissary cost and other expenses, and that's just because Papa John's decided to reclassify a few expenses and combine them into one line. The business itself, from a balance sheet, there's nothing much interesting here aside from the fact that there is a large amount of long-term debt sitting there, which would have quite an expensive interest impact on the business. Over the past few years, the business has been doing a fair bit of share repurchases. You can see in 2023 there was like 224 million. But capex wise, it's pretty stable. And the model that Claude AI did was like a basic model, but it does forecast things to mostly from historical averages. And you can just see, like, without any changes or anything, Claude AI is just deduced the share price between $50 and $57, which is actually slightly above the PE offer, which does make sense. And here I'm just deleting FY25 because we're already in the FY26, so we should be looking for the full year 26 financials and onwards in terms of valuation. One thing did catch my eye here was the calculation of the WACC, where I felt like the AI took a long-term capital structure, but the WACC looked pretty low in my opinion at 7.4%. So I decided to actually increase it a little bit more, just by taking the current capital structure, which is more, I guess, debt heavy than what this Claude AI has assumed. Look, it's not perfect, but it does, let's say, 70-80% of what you would need for a very basic model. And it's good enough for you to actually start building your own assumptions on top and actually start tweaking and running sensitivities to get a good sense of what are the main drivers of the business. And here you can see me, I'm just looking at the long-term debt number, and this was when I realized, we're talking about a $1.2 billion company that has 700 mil of debt. It's quite a fair bit of debt that's sitting on this business. Obviously, with the Qatari Irth Capital, these guys are going to put on way more leverage. That's just a typical classic LBO style investment. And we'll see later how that actually impacts their returns and valuation. And then looking here, obviously with the new WACC, you have a lower share price range. And surprisingly, the average here actually gets close towards what their offer price is. But obviously, their offer price it was a premium, for like $47 is a premium to what it was trading at. But I'm sure these guys have a lot more upside that they do not want to pay away as an investor. Claude AI did a really good job here in terms of setting up the transaction structure, sources, and the financing mechanisms here. Having a look at this, the assumptions look pretty spot on, 4.5 times, and another 1.5 times in senior notes, getting you to around 6 times overall leverage. Pretty spot on. And then 7% in terms of the margin, I think was quite good. Maybe the senior notes were a bit high. And then here I've just changed the exit multiple to equal to the starting multiple, just to assume that there is no multiple expansion of the business. Looking at the financials here, it's built everything pretty well, and it even considered a cash sweep function, which I think I decided to remove later on because it seemed a bit too complicated and unnecessary. Instead of cash sweeping, just assume that it sits on the company balance sheet until the end of your investment horizon, which is the end of your year 5. And when you look at the company and you look at the interest expense here, when you start adding on such a large amount of debt, there is a lot of interest, but also, if you pay it down and it does deleverage pretty fast due to the cash flows, this business can sustain that amount of debt. And obviously the investors would have done their own sensitivities and figured out what was the optimal or ideal leverage that they should put on this business without putting too much stress that it puts the business at risk of bankruptcy. Having said that though, there have been plenty of examples where PE funds have just put in too much and things have just blown up. And then looking at the return for the sponsor here, it's quite low, 12%. And here I was looking at, so obviously this business with the current assumptions that Claude AI has is not, 12% is a low investment for a traditional PE fund. Typically they're going to look for something towards like, anywhere from 20 to 25%. Arguably, given the market's more competitive these days, they might be willing to accept higher teens. But otherwise, it will be very hard for an investment committee to approve for such an investment. And so my suspicion here initially was that the cost was where the private equity players felt like there was more value. Growing revenue is definitely going to be hard, but cost synergies is something that you can actually control. There's more control of, and there's more certainty. And so running the numbers here, the cost was actually so high. The EBIT margin was only like below 10%. So it was going from 6% in FY26, and then Claude AI was assuming that you get to like maybe 10%. And you know what? That's actually something that you would assume, which is lower cost over time as there's more cost and financial discipline in the business. But the question for me was, obviously this was a key driver for the return for the investors. Like changing the revenue growth itself didn't actually do that much to the returns. It was actually all in the cost. And for me, I then started thinking, okay, so what is the industry standard? Because if these guys are at, like, let's say 6 to 10% EBIT margin, what are its competitors such as Domino's and Pizza Hut doing? Because they are very comparable businesses, franchise models that are also very global. Looking into the financials here, when you look at the number of stores internationally and even in America, arguably, like, the number of stores haven't really increased year on year. What's really happening is that they've closed a bunch of stores that are unprofitable and they've just opened new stores. However, the total number of stores has not increased. So why would a private equity fund want this company is the key question. And in my mind, I think there's maybe three to four main reasons why somebody would want this. So I think number one is this is a asset-light company. Most of the business is actually dependent on royalty streams, which doesn't have a lot of capital expenditure. 90% of the stores are franchised, and so the income stream is also very predictable. And typically the franchise models are the highest margin business in the restaurant sector. And then number two, these guys are really taking advantage of the stock situation. Obviously, the stock is down significantly over the past few years, and the old saying is you always buy low, sell high. So obviously buying at a low valuation price is a good thing. I think the third reason is that there is a lot of operational levers that the fund can actually implement. Obviously, the main one will be closing underperforming stores, cutting corporate costs, renegotiating supply chain contracts, optimizing the menu, the product, but also investing digitally. And these are typically very straightforward operational levers that PE funds can actually help implement. And when you take this company private, you remove the pressure of reporting on a quarterly basis, and as soon as you go private, you get a good 5 to maybe 7 years where you can just focus on improving the business as opposed to making public disclosures every quarter. And then finally, the fourth one, I think on the strategy side, there is potential, given that it is a Qatari-backed fund. Perhaps they do think this is something they can continue to expand internationally into both the Middle East and Asia. And so it might be something that they can leverage in their network to actually help the business to grow internationally. But again, I think there'll be quite a few challenges there, just given how dominant Pizza Hut and Domino's are on a global scale. And just looking through the investor presentation here, which is something that I like to do quite often because it does provide, I guess, a more infographic type of presentation of the material. You can really see here that there's a lot of messaging around how they are going to improve the business. So they are aware and they're trying to address these problems to the market to set like high-level messaging and expectations around, this is what we're going to do, this is what we're going to do better. And then you look at the stores here. I was just doing some research, just generic research here, and obviously within the Asia market, the two largest Asian markets, China and South Korea, they definitely are not the number one player. And you've got a lot of like stores from Pizza Hut. Like Pizza Hut had 4,000 stores. And so what I did here was I told Claude AI while I was looking at the financial reports and annual presentations to grab the historicals of Pizza Hut and Domino's. And the intention of this was to get an understanding of what the cost percentage of revenue was for its peers, and just to get a feel for whether, like, how out of line Papa John's was, and if it was to normalize towards what its competitors were doing, what type of impact that would have on the returns for a sponsor, in this case the Qatari investment fund. And you can see here, Domino's is operating at a EBITDA margin of like 17%. Pizza Hut is around, I I think Pizza Hut is around at 55. Might be because it's a more franchise heavy model. But even looking at Domino's, when you got double digits, obviously single digits for Papa John's really tells that you've got too much cost in the business. And then here I'm just doing some checks just to see what other cost line items seemed a bit high. But I would say they were broadly in line. And the key thing was really just the company restaurant expenses that were really, really high, in my opinion. I also asked Claude AI to grab me some comparables, trading comparables. Obviously, without broker reports here, the best you can do is actually grab historicals. In some cases, you could use, I guess, management guidance to look 1 year forward. But typically on the job, we would get, reports from other banks, Goldman Sachs, Bank of America, Morgan Stanley, JP Morgan, and they'll write about the stock, and you'll take the average of all those estimates by those brokers, and you'll come up with some comps. And it's interesting here where you can immediately see Papa John's on an EV LTM EBITDA basis was only at 10.7, almost half of like Domino's. And then Yum brand is a bit different because it's a bit more diversified in terms of the food market, but it's at 20 times. And so clearly Papa John's is definitely, I guess, undervalued. Well, let's say valued lower, given the issues it's been having in its business, which is why it's why it's become vulnerable, and why the Qatari fund has really actually decided to target the business. And here you can see, Papa John's was looking to close 300 underperforming stores, and that's quite a big number. So, whether, like, how do you improve the business from here on, I guess, is a big question. But looking at the product, they're just looking at Reddit, like, people don't really rate the product, and I guess that's always, a terrible sign. This deal definitely has its own risk. First of all, we don't even know if the board is actually going to accept the offer, especially when they've previously rejected a higher offer. The board could see this as a opportunistic bid by the private equity fund, given where the share price is. But hey, the stock price is very vulnerable. I think second, the competitive environment for this sector is actually quite brutal. Third-party delivery apps like DoorDash and Uber Eats have really eroded that delivery advantage that pizza stores used to have. Now everybody can actually just deliver. Your mom and dad pizza store can do the same. Third, I think from a macro environment perspective, these stores typically have clientele from lower income background, and given how the economy is doing right now, people might just eat out less, and especially with minimum wage hikes as well in different states, definitely that's having a big impact on franchisee margins. And I think lastly, the brand damage from what's previously occurred back in 2018, I think, people tend to remember that, and that does have a big impact. So obviously the deal financially looks pretty good in terms of, straightforward strategy. You try and cut costs, you're buying at a low price. This is something that you can execute on and actually have some form of certainty that you will achieve your 20% IRR. But obviously there are risks. If you found this useful, smash the like button, subscribe if you haven't already, and drop a comment below. Do you think Papa John is a good investment at this level, or is this just a risk investment by the Qatari fund? I did love to hear your take. Thanks for watching, and I'll see you in the next one.